Welcome back to Business Week here on Arise News. I'm joined now by Gbemi Alonge, economic analyst and founder, Nourish Box, to review some of our top stories in more detail. Good morning and welcome to the show, Gbemi.
Hi,
Great to have you.
Thanks for having me. Thank you.
So we want to start with the Fed story, Jerome Powell. I think, we've had a lot of sweeping changes in the US in terms of tax, trade, immigration. And I imagine for any sort of economic policy decision maker, monetary policy decision maker, you sort of have to read the impact of all these things on the economy, on the flow of money before you decide what direction to move your rates. How do you think all of these things are impacting the way the Fed is thinking about its decision making?
I think there's definitely been some pressure directly from the president, just asking for a reduction in the rates. And, there have been jabs, there have been direct asks, all of that. So I think it definitely does have an impact on the decision, right? But however, you'd see from the interview, there was no outright decision, right? It was just a posture for the most part. So people have now started to react as a result of what they think is coming. Now, it's up to the Fed, when it's time to actually make the decision, to decide based on, more recent data. I mean, obviously, in the last few months, they've seen, especially July and June, they've seen the labor market sort of slow down and sort of cool compared to what it was before. So despite the tariff increases and I guess the resultant or expected inflation that should come from that, they're still seeing, the data still informs the decision that will be made, right? And they're still seeing if labor markets are slowing down, then it might be worth, reducing rates or even just keeping them as they are. So, definitely there's been pressures, but I think it comes from both ways. So on the one hand, there's a posture, and data already shows that based on the speech that was given yesterday, markets are already swinging towards sort of the stocks, rather than bonds or rather than bills, people are starting to react.
Rate cuts, you think?
Exactly. So people are starting to, people are already anticipating a rate cut based on that information. However, there's still cautious optimism, right? There's still caution. No one is dumping, bills and then moving straight on to exactly. So definitely there's impact, and we're seeing it from both ends.
Well, I certainly think we're either looking at a cut or a hold on rates. I mean, you talked about the posture. The part of the mandate of the monetary authorities is sort of to ensure full employment, and then price stability. And I think in this sort of post-pandemic supply-constrained world, it's becoming really hard for them to strike that balance. And I'm thinking, what should the posture be? I mean, if you were advising the Fed, I know that's a tough one. What would you say that posture should be?
I think certainly I support what the Fed is doing, right? There's still caution. No one is throwing caution to the wind and then saying, oh, we're going to cut rates, despite what could happen, especially given the kind of leadership that the country has and the volatility that comes with, we've seen the presidents coming out to issue some significant tariff hikes on different countries, and that obviously has impacts on, consumer spending. If the goods coming into the country are more expensive than they were before, inflation would obviously rise. So there's still that initial, gauge of what's going to happen, initial caution of what's going to happen. However, if I was to advise them, definitely, businesses, consumers have to spend way more to borrow, a lot of, and that's obviously going to affect the growth of the economy. So rather than stifle growth, relax a bit without obviously allowing inflation to run wild.
Yeah, interesting thoughts. Let's move over now to Africa. Tata India's Tata Motors is making a return to the South African market at a time when we're seeing a huge influx of Indian and Chinese automakers into the same market, offering potentially strategies that are undercutting other producers. But what do you think this says about South Africa's auto market, and maybe even as a destination for investment?
I think it says a lot about even Africa as a whole, right? So when you start to see certain investors flow into a certain market. It requires, I mean, first thing it says is that, the market is open for business generally, right? But then the caliber of like products that are being put into the market. So for example, Tata was still operating its commercial vehicle line, right, in South Africa, but then it only just reintroduced the consumer vehicle line.
Right.
And that's to compete directly with Chinese markets. And part of what they're trying to do is beyond just introducing cars, right, they're also trying to introduce, friendly financing arrangements for consumers, right? And this is directly competing with Chinese car makers, because the Chinese cars are typically more affordable for consumers. They basically do what a car needs to do, right? Move you from point A to point B safely. And but then you're finding a situation, for the most part, right? There's even been an increase in South Africa's consumer car purchases in the last few months. So first and foremost, it means that South Africa is open for business. Consumer disposable income is also increasing because people can afford to buy cars. But more importantly, there's an influx of more affordable cars, cheaper cars for consumers. And Tata is just trying to get in on the action, really.
Yeah, indeed. And certainly more consumer option. Now, back to another monetary policy issue, this time in Europe. Decision to hold rates, right, for the ECB. How significant do you think that will be, not just for the ECB market, but for other emerging and frontier markets?
I think what the ECB is trying to do really is ensure that in Europe, right, they're able to sustain themselves without the shocks of the global economy, right? So we've seen inflation in Europe in the last 2 to 3 months, basically steady, like at 2%, which is what the ECB has been trying to achieve, right? So they need that, they've achieved their targets. However, there's still these issues of, businesses could still be affected by the tariffs that have been imposed by the US. And despite the fact that they've been trying to reach an agreement with the US, that's still, they seem more optimistic than everyone else, because the US hasn't exactly said anything. And until, I guess, the president consents to things, given the historical trend that we've seen since the beginning of the year, anything can happen, right? When it comes to the US, anything can happen. Tomorrow, like, tariffs might even double, right? So nobody really knows what's going to happen.
And this is what really strikes me, because I feel like maybe there's a bit of complacency, especially because there's no firm EU-US deal
yet.
So it's almost like the Eurozone has confidence in its own ability to manage and weather whatever tariff storm may be on the horizon. And then the other side is, do you think perhaps in light of that the ECB may have underestimated potential inflationary pressures?
So I think the inflationary pressures have not manifested yet as much, right? So I don't think that I think they're remaining steady. So there might be a little cut, but then for the most part, rates are likely to remain the same. And if that happens, right, for them, especially towards Q4, with the winter coming, energy prices are likely to increase, and demand for energy as well, and that would likely increase inflation. So ahead of that, right, they seem to be positioning. There's some countries though that feel like you said, they're a bit complacent. Like you can't just you can't just wait for the US to decide what to do for your economy, right? They are yet to. Some products like steel and aluminum are currently facing 50 or so % tariffs like on their products, and that's likely to affect businesses, especially in certain countries. Cars have, tariffs on cars are as high as 30-something% for some countries, and countries like Germany are feeling the pinch, right? And they've been asking for like a bold, decisive move. Now with the US, I feel like the fact that the EU is positive. They've had discussions with the US, although the US hasn't come to say anything in the coming months weeks. I feel like we'll see what the decision is. However, the fact that they haven't retaliated either means that they are in a weaker negotiating position, or they're quite positive that the US has made some, I guess, unofficial, agreements with them that we'll just see in the next few weeks.
Now, I want us to touch on this story because I think it's potentially a major policy shift. Kenya wants to swap its U.S. debt, denominated debt, for Yuan, the Chinese currency, especially given the U.S.-China competition. How historic could this potentially become as a policy move?
I think the debt is the one directly to China. That's the $5 billion railway debt. China hasn't agreed yet, so with these things, it's very tricky. It would definitely have a huge impact for them in particular, right? Because first, that reduces...
For Kenya?
For Kenya, yes. Okay. That reduces the pressure on debt servicing, right? As opposed to paying, high interest rates, they would be paying, much less, which is good for them, right? And we're already seeing the US, the dollar sort of weaken after the announcement yesterday or the speech yesterday. They were already in a goodish place if things continued like that. But now, moving to the yuan, it just makes life easier for them. It's a significant policy move, especially because Kenya is in a really terrible debt situation right now. So debt isn't very sustainable. They have a reserve of around 10 billion. Meanwhile, their debt service for 2025-2026 financial year is around $1 billion. So that's around 10% of their entire debts. And they're looking to even renegotiate and restructure their euro bonds and domestic debt as well. Yeah. Some of which we don't even know what the values are, right? And some of which are due as early as next month and next year. So that posture in the entire posture of the Kenyan government in the past few months, and even years, because it's not just been now, right? Since last year when they've been trying to push like a new finance bill to fund their budgets and also these debts obligations, and obviously that received a huge pushback from the public. Since then, there have been different postures by the Kenyan government to sort of plug in these debt holes.
And it's interesting because this shift to yuan also signals that the Kenyan government seems to have somewhat confidence in the stability of the Chinese currency. And I'm thinking, what if there's some major economic headwind in China, or it suddenly imposes stricter capital controls? Is that policy sustainable, thinking ahead maybe to possibilities?
For them, I guess like you said, they're quite confident that the Chinese economy, at least to the extent that they're able to meet that particular obligation, right? So it's directly for the $5 billion that they owe and the interest, obviously, that accrues on that they owe the Chinese government or the Chinese, their Chinese creditors, right? So they do have confidence. But I think what they are more concerned about is for the US, the amount of US dollars they have. They have very limited leg room to do a lot with what they have. Indeed. A lot of the obligations that they have were hinging on some inflows from the IMF and World Bank, which have not come, right? And in some cases, they've even turned to their local banks for some leeway or for some, I guess, bailouts, which they have received. The fact that they are even considering a Eurobond buyback and some other extreme debt measures means that they're already in debt distress. So I think for them, it's more like they're torn between the devil and the deep sea. And I guess
it's in a rock and a hard place. Interesting times. We'll certainly be following that story. And of course, the big news of the week is Nigeria's FX reserves, 4-year high and all of that. It would be just kind of simple to ask you, what are the likely drivers for this? I think by and large, many of us know what the likely drivers for this are. But what do you think has been the single biggest factor that has helped to shore up our reserves to a 4-year high?
I think it's investor confidence in the economy. And we see this through, the inflow of investments, portfolio investments, whether it's automobiles or T-bills or the capital markets or... so essentially, we're seeing an investment inflow, which is likely to even improve, given, if the U.S. actually cuts its rates, then we should expect, more inflows into economies, emerging economies, especially in Nigeria. So But what we're seeing now, in different ways, even in trade, right, we're seeing a lot of stability that has restored, or that seems to be restoring investor confidence, right? Stability in terms of, on the monetary policy side, in terms of investors being confident that when they need to expatriate their funds out of the country, they can, because the central bank has restored orthodox monetary policy. There's more predictability in the markets, right? There's we're also seeing that in the capital markets, lots of portfolio investors coming back, investing a lot. In the oil markets as well, right? Whenever there's, Nigeria has improved its oil production, and that signifies a lot of, that signifies first confidence in the government to actually tackle security matters where they matter a lot for the economy, right? Well, still, security is still not perfect in Nigeria, far from it, in fact. So even things like FDIs are still, they're trickling in a bit, but they're still not as strong. That's but then that signifies that, security is still a bit of an issue, and there's still some major structural issues in the economy. But on the portfolio side, the fact that we're able to increase crude oil production, right, and get inflows from that. And even though we're not even hitting, I guess, the federal government's crude oil benchmark price, we're seeing inflows consistently. That speaks to a lot of, and even, the refinery being able to sell refined petroleum outside of the country, all of that signifies that there's stability where it matters. On the fiscal side as well, the government is trying to implement some, we're seeing trade, let me just even move to trade, right? We're seeing a trade surplus in the past 3 months, or in the past year actually, or 6 months since the beginning of the year. There have been trade surpluses. That all signifies that, Nigeria is stable enough on the portfolio side for investors to throw in their money and get it out when they need.
Great sentiments there, Gbemi Alonge. Thank you so much for being with us and offering your insights.
Thanks for having me.